All right, let's take a couple minutes and change our concentration just a wee little bit, and let's look at some valuation questions, valuation issues, if you will. So, how do you find the value of a bond? The value of a bond is the present value of all of its cash flows. So, in this class, we have conveniently ignored some of the time value questions. We haven't explored that in a lot of detail. So we have a spreadsheet, and quite frankly, most financial calculators will help you with this as well. So you really don't need to know the formulas, but there was an understanding that you're going to get money in the future, and we have to figure out what that money would be worth in today's dollars. That is the concept of valuation. So in this instance, we're looking at bond valuation. If you look at the module that I provided for the class, there is a spreadsheet for bond valuation. It's called Bond Valuation and Duration Worksheet. This will help us solve all the bond questions that we might have. And we're going to go through a series of those problems in the next several slides. So first we have, what is the value of a $1,000 par value 20-year bond, pays a 9.5% compounded annually coupon when the market interest rate is 10%. So as you can see, you can fill in the data here. All the data is there for us. $1,000, 9.5 is the coupon. We only pay annually, that's once, so the coupon per period is 9.5%. Required returns 10%, 20 years. So this bond has a value of $957.43. So essentially what this is saying is the most you'd be willing to pay for this bond is that amount, $957.43. So what happens now that we understand value? You can see what a bond is worth. Let's see what happens if we know what the price is. Because quite frankly, that's what we know most of the time. We really don't know the value, but we do know pricing. So we want to now solve for the returns and yields, knowing that what the price is ahead of time. So we have 4 or 5 different things we can think about, or different types of returns that we might have an interest in. The current yield indicates the amount of income you would earn if you bought the bond today, you held it for a year, and you only incorporated the interest for that year. So it really is just the annual earnings, annual return based on today's price. So as you can see here, it's the coupon payment divided by the market price. So the next return we can look at is something called the yield to maturity. Sometimes they call it the promised yield. In a corporate finance context, we might refer to it as the internal rate of return. But basically it says, look, this is the return you get if you buy the bond and you hold it till maturity. So in our formula, we change our formula for valuation, and we put the market price in the beginning, so we know the market price, and now we're going to solve for these R's. So it's a much more complicated process, but a computer helps us do this quite nicely. So here we have this same bond we were talking about. If I were to tell you that this bond is selling for $935, what would that tell you? Well, in the very first year, you'll spend $935. You're actually going to receive $95 in coupons. So the current yield this first year is 10.16%. The yield to maturity over the length of this bond, which is a 20-year bond, if you hold it to maturity, you would earn on average 10.28% per year. So again, these are two measures of return, one for the current year and one for from here till the bond matures. So the yield to maturity, right? It's a calculation, right? We're solving for this R, but it has some challenges with it. Number one is it assumes you hold the bond to maturity. It also assumes that whatever coupon you receive, you're going to reinvest it for the remainder of the bond's life at a rate equal to that yield to maturity. Well, if interest rates are falling, that might not be possible. Quite frankly, this is actually a repeater, right? The interest on interest assumes that you're actually even going to be able to get a reinvestment, if you will. So this is sort of a redundant sentence here. Let me get rid of that so we don't think about it too hard. Next, so what happens to the value of a bond when interest rates change? This all comes from this bond valuation spreadsheet, and this is for the bond that we're following here. And as you can see, as interest rates rise, risk rises. Investors want a higher rate of return on their investment. The only way they get a higher rate of return is if prices were to fall. Now that's kind of confusing, but the way I want you to think about this, think about you're thinking about buying this bond that we're looking at, and all of a sudden interest rates in the economy go up. And you say, wow, I can buy this bond at this interest rate, but I'm fixed in that. But interest rates have risen, so people that were going to invest after me, who buy bonds later, are going to get a higher rate of return than I am. So as risk increases, you want a higher return. Those things that you're thinking about buying are going to have prices that are lower. The reason they go down is because you want to get paid more. And as you can see in this little graph, I mean, here's the graph, obviously, but in the table, as interest rates go up, the value of bonds goes down. So we can see here that there's a change, right? And here, where the interest rate was 8%, that's where we started, right? This bond is worth $1,225. What about yield to call, right? We talked about callable debt. We know that if a company wants to recall its debt, it's going to have to pay a call premium. There's a price it will have to pay. So what happens? In this case, this bond is at 9.5% annual, market rate's 10%, right? Selling for $9.35, and it can be called in 5 years. So in 5 years, the call premium, the price they'd have to pay, is $1,095. So we find out that the actual yield to call is 12.81%. So which would you rather have, 12.81% or the 10% over here? Obviously the 10%, so you want to buy this bond, but would you want to hold this bond to maturity, or would you hope that they would call it at least in 5 years? And the answer is, if interest rates can fall far enough and this company calls, you're going to get a higher rate of return than if you held it to maturity. So again, our hope is interest rates fall. Another way to look at bonds, though, is what happens when I don't really want, I want to buy this company's bond, but I don't want to hold it for 30 years. Maybe I have a bill that I want to pay. Let's say I owe $100,000. So today I'm going to buy 100 bonds. Those 100 bonds are going to mature in 10 years, and in 10 years, I need to cash them in. So how am I going to do this? I need to understand what rate of return am I going to get from this investment if I don't hold for 30 years, I don't consider the call, but what if I just want to hold it for 10 years? So we want to calculate what's referred to as an expected return or a realized return. In order to do this, we're going to have to make some predictions. We're going to have to predict what we think the interest rate is going to be in 10 years. If we think interest rates are going to fall from 10% to 8%, what's the value of this bond in 10 years if interest rates do go from 10 to 8%? So what you can see here, the change in years, we started out at 20 years, now we're at 10 years, right? So that's 10 years expected from 10 years from now. That gets us to 20 years total. This bond in 10 years should be worth $1,100 if interest rates go from 10 to 8%. So in our bond valuation, we have a place to put this expectation. We expect the bond to be worth $1,100.65 in 10 years. So the realized yield to maturity is 11.21%. So if this is my strategy, all right, I'm better off than holding it to maturity. I'm better off than selling it at the end of 1 year. But essentially, I'm going to earn on average 11.21% from this strategy of holding this bond not for 30 years, not for 20 years, but I'm only going to hold it for 10 years. So let's think about bonds and prices and how we can kind of pool all these things together, right? Prices and yields move in opposite directions. The price curve, though, if you were to graph, I'll show you here in a second, if you were to graph the returns and the prices of bonds based on the required returns of the company, you see that it is not a straight line. It is a curvilinear function. And the longer the maturity, the more sensitive the bond's price is to changes in the marketplace. So your book gives us a nice little graph that shows that whether you buy a bond at a discount down here, whether you buy a bond down here at a discount, or whether you buy a bond at a premium, ultimately this bond is worth $1,000. So we know that bond prices move towards maturity or par value at maturity. So here's what I got from the bond valuation mechanism. We started at 30 years. We worked our way down, right? Assuming no changes in interest rates, the value of a bond approaches par. As time dwindles, as time moves, we ultimately end up at $1,000. So even if interest rates change, though, this value is going to change over time. But eventually, what will happen is, regardless of whether it starts at a discount and moves up or vice versa, it's always going to end up with a value of $1,000. Again, that's one of the things that attracts investors to bonds. They want the income. They want that cash flow. So what is an investor going to do when the bond matures? They're going to take the $1,000 and they're going to buy another bond. Now their risk at that point is, what are the interest rates in the economy going to be like, and what kind of coupon can they buy with that $1,000? But between now and then, as long as the company doesn't go bankrupt, they're guaranteed to get their $1,000 and the cash flow income stream. So we have one more section to go where we'll talk about a little bit more detail about risk and how interest rates impact bonds.